Hello, welcome back to another video. In today's video, I'll be covering what stocks to buy when the rate starts to come down. So for reference, this is my portfolio. I'll be covering some of the stocks in here, the ones that have catalysts behind of them when the rate cuts start to come in. So for the first stock that I'll be covering today is actually Capital Land Integrated Commercial Trust. So these are your REITs in Singapore. A lot of your REITs in Singapore have actually outperformed the S&P 500 this year. So for example, Capital Land Integrated Commercial Trust is up around 16% year to date. And for a lot of your REITs in Singapore, they have underperformed the broader market since around 2022 because of heightened interest rates. So when your interest rates are higher, what happens is your borrowing costs for all these different REITs will be a lot higher than what it normally is, which reduces the net profit margin for all these different companies. So they operate with leverage, and what they do is they need debt, they need to borrow money to buy new properties, which is why they've seen increased interest expenses for all these different companies. So when your rate cut starts to come in, it will reduce the interest expense and it will increase the net profits for all these different companies. So you could definitely see a normalization in terms of their earnings, as well as the stock price along the way as well. So for my portfolio, I own these three REITs here. I own Capital Land Integrated Commercial Trust, I own Mapletree Industrial Trust, as well as Fraser Centrepoint Trust. So I'll be covering Mapletree Industrial Trust first. So for Mapletree Industrial Trust, if you have to look at the portfolio of this company, they operate mainly in the data center portion as well as the high-tech portion. So they have a large proportion of their assets under management under these two segments. So if we see continued growth in terms of data centers in all these different places that they operate in, then this could be bullish for the company. I think it is one of the cheaper REITs in Singapore right now. The next stock that I'll be covering is Fair Isaac FICO. So FICO year to date is down around 29% and it is currently trading at a 55 times of earnings. This is a company that could have tailwinds when the rate cuts start to come in as well. So for FICO, as well as all your different other mortgage companies, your mortgage originations by credit score has been declining over the years. So we've seen a decline in terms of the volume of the scores. And when the rate cuts start to come in and when your housing activity starts to recover again, then you could definitely see a growth in this segment, which could be bullish for FICO. So for FICO, the concern right now is that the FHFA will try to control its pricing. But of course, the FHFA, they can't do so. FICO will keep increasing the prices, and along with volume increases, we could see a re-acceleration in terms of the growth of the company. So there's the existence of your tri-merge as well as your maintenance of your tri-merge, which is overall bullish for a company like FICO. The next stock that I'll be covering as well is Pool Corp. So if you're wondering where Pool Corp is in my portfolio, it is still in my portfolio, but it's a bit too small to be labeled over there. So for Pool Corp, it was up around 5% on Friday. This stock is currently trading at a 29 times of earnings. I haven't added into this position because the stock is not particularly cheap. So for Pool Corp, it is a similar story to your REITs. So Pool Corp is the largest player in your pool segment. So a lot of your pools, they are attached to houses as well. So when more houses are built, it will lead to more pools being built. But of course, there's a lag effect for Pool Corp. So if the housing market recovers in the next 1 year or so, then there could be a lag effect before the earnings start to come in for Pool Corp. For a buyer of the stock, it could be good news because you get more opportunities to buy. And for Pool Corp, it is a net beneficiary of your rate cuts that could come in soon. The next two stocks that I'll be covering as well are your home builders, specifically NVR as well as DR Horton. So NVR as well as DR Horton, they are the highest quality home builders in the US. What they do is they have option for all the different lands. So they don't actually own the land in their balance sheet because it will lead to depreciation as well. They own the option to buy up the land. And this is great for these two companies. They don't have to bear the cost of buying up all these lands. And if your rate cuts start to come in again and we see normalization in terms of housing demand, then it could boost up the earnings for these two companies here. Next section, I'll be covering some of the stocks that have been falling over the past few days. So the first stock that I'll be covering is actually Intuit. Intuit is down around 6% post earnings. It is currently trading at around the 48 times of earnings. So for Intuit, the reason why the stock dropped was not because of the earnings itself. The earnings were quite decent. The problem with its earnings report itself was actually because of the guidance that they are giving out next year. So guidance next year is slightly softer than expected. They're expecting revenue growth of between 12 and 13%. They're expecting net income growth of approximately 17 to 19%, which is below the street's estimates. They're forecasting around a 13 to 15% EPS growth next year, which is substantially lower than what they just did in this year itself. So for Intuit, it is currently trading at a hefty valuation. So it's currently still trading at a 48 times of earnings. So currently I view the stock as expensive. This stock is one that could look interesting if it drops to below a 40 times earnings. But of course, even at below a 40 times earnings, it could still look expensive on a P/E ratio perspective if the growth for the company can't maintain itself. The next stock that I'll be covering is actually Intuitive Surgical. So this is an incredibly interesting company. The stock is trading at a 66 times earnings and down around 10% year to date. So for Intuitive Surgical, they hold around 60% market share of your surgical robotics market. So they're the largest player in this space, and the company provides an entire ecosystem. So they sell the machines, they maintain the machines, and they sell the training for all these different machines. So when your hospital have new doctors trying to use these machines, they have to approach Intuitive Surgical to get training from them. And besides that, there will be recurring streams of income coming into the business because they have the maintenance portion of the business. And also, Intuitive Surgical is expanding globally as well. So they're the largest player in this space. They hold around 60%. So that is massive scale that the company can leverage on. And currently, the company has more than 80% of its revenues coming in from recurring streams of income, which is extremely predictable revenue. So it is sort of like an ASML with a less strong moat because it is not a complete monopoly, but with a much predictable stream of income coming into the business because they have the 80% which is recurring. So for Intuitive Surgical, this is a company that looks interesting. Of course, if you're not a doctor in the field, it could be a bit harder to understand. This is one that could look interesting if it falls a lot more. So for Intuitive Surgical, the problem with the company as well, similar to Intuit, is that it trades at a hefty valuation. So on a forward P/E ratio basis, the company still trades at a 55 times of earnings. This is still relatively expensive despite the predictability of the company. So for Intuitive Surgical today, I would avoid this stock simply because of valuation. But of course, if it drops a lot lower, if it continues to fall, then this could be an interesting company to look at. Next portion, I'll be covering some Singapore banks as well. So a lot of your Singapore banks are down year to date. In fact, UOB is down around 3% year to date. OCBC is around flat year to date. And currently, they're underperforming the broader S&P 500. So for Singapore specifically, the interest rate, the risk-free rate here, is currently at around 1.6%. And the average risk-free rate over the past 15 years or so is around 1.5%. So we are more or less done in terms of the decline in your risk-free rate in Singapore already. The downside risk in terms of your risk-free rate is a lot lesser compared to in the US. The US is currently at a 4%. They are trying to reduce it to around 3%. So that's around a 1% more to go. As for Singapore, the risk-free rate, although it is not adjusted by MAS, it is currently now at around 1.6% already. So that's why I think the banks today look interesting. We could see 1 or 2 more quarters of weak earnings coming in. But after that, we could see a normalization in terms of the earnings. And if the stock prices continually falls, then these 3 banks could be interesting ones to look at. Next portion, this is what Howard Marks has said about the markets today and why he thinks we could be in an early stage of a forming bubble.
And an opinion. None of this is factual, but it does seem that stocks are expensive relative to what I call fundamentals, or you might call reality. And the outstanding reason I think is that there hasn't been a serious market correction in 16 years, so people get out of the habit of thinking about market corrections. The biggest single mistake, I've been thinking a lot, what is the biggest single mistake investors make? And I've concluded that it is that they conclude that the way things are today is the way it'll always be, and the things that have been happening will always continue to happen, whereas reversion to the mean is much more likely. So I just think that it's worked very well. Being an equity investor has worked very well. Doing it on leverage has worked even better. Concentrating in a few stocks has gone very well. Investors are by nature optimistic, and that optimism dies hard. I just think that the fluctuations of the market are mostly related to psychological fluctuations, and people go from neutrality to liking stocks, to liking them a lot, to liking them a ton, to liking them too much. And that's the continuation that creates bubbles. And, we're probably in the early days of that.
When you talk about...
So what Howard Marks is saying over here is that market valuations are overstretched. He thinks that the markets are swinging like a pendulum. and we're currently on an uptrend towards the euphoria period. So if you read his book on the market cycle, currently he thinks that we're on an uptrend towards the peak of the pendulum, which is something that I agree on as well. I think market valuations are high. If you were to look at the S&P 500 on a forward PE ratio basis, it is currently trading at a 22 times forward earnings. This is on a historical high basis. So if we see a reversion to the mean, then the stock market could drop a 20-30% or so. That is entirely possible. So be cautious when market valuations are high. I think there are opportunities out there, but not too many. A lot of the stocks today are trading on speculation, trading on hype, and trading on overextended valuations. Last portion, I'll be covering some questions left in the comments. So the first one, it says, can't believe you sold Golden Goose Meta. Meta is actually the Max 7 company that jumped the most after its earnings, up to 12% a day, I believe. So for Meta, the reason why I sold the stock was simply because, number one, I disagree with their capital allocation. Number two, I disagree with their accounting. So if you have to look at the depreciation across the years, so they're currently forecasting a lifespan of the GPUs of upwards of 10 years, which is overly bullish in my opinion. So for Meta, despite the blowout earnings, I think the company might be overstating its earnings, and that's why I decided to sell the company. After all, it was one of the smaller positions in my portfolio, probably one of the lower convicted ones, and that's why I decided to sell Meta despite it being up around 12% on earnings. The next comment, it says, China can make their own space machine, they will develop their own EUV as well, sooner than most people think, but the West can keep underestimating China. So I agree with this. I think the Chinese people are underestimated by the West will continually underestimate them, which is the risk with ASML. I think the company faces substantial risk in terms of your Chinese advancements. China has been able to do very well in a lot of your different departments, and they're pouring significant amounts of money to the chip industry, which could be bearish for ASML. So if you have to compare the R&D of Huawei as compared to the R&D of ASML, ASML is substantially lower as compared to Huawei. So sooner or later, given the amount of money spent, we could get an alternative EUV machine in China. So China is now progressing with the light. They're trying to basically create their own laser, which is why I'm slightly cautious with owning a significant portion of my portfolio in ASML. I hope you guys have found this one useful and invest.